Hey folks, welcome to a product review at Finominal. Today we're going to compare high dividend yield versus dividend growth funds. Now, high dividend yield funds are simply funds that select stocks that feature high dividend yields, versus dividend growth funds are focusing on selecting companies that have managed to grow the dividends consistently and often also are expected to continue to do so going forward. Now, from a pure yield perspective, you can easily differentiate them because the high dividend yield funds tend to have yields around 3%, versus dividend growth funds are much lower than that, currently around 2%. We selected two high dividend yield funds, one from Vanguard and one from iShares. And then again, we selected two dividend growth funds, one from Vanguard and again from iShares. So let's have a look in terms of how similar high dividend and dividend growth are. And from a pure portfolio perspective, we can see that these products actually are quite different in a sense that, well, the product from Vanguard is highly diversified with 535 holdings compared to that second high dividend yield ETF from iShares with only 80 holdings, versus the two dividend growth products are more diversified. Now, next we're going to have a look at in terms of doing a kind of like holdings-based factor exposure analysis. And so here we can compare the underlying portfolios on various fundamental and technical metrics. Now, broadly speaking, we do see that these funds are all in the same quadrants, more or less. And so broadly speaking, it means these portfolios are somewhat comparable. We do see that compared to the S&P 500, which we have chosen as a benchmark, these companies tend to be smaller and also cheaper from a PE perspective. We do see that the underlying portfolios have kind of like negative growth or low growth from an EPS and sales perspective. We do see that most of the stocks have been underperforming recently. And we can see that from a profitability perspective and leverage perspective, they're not that attractive. Profitability tends to be in the lower side, and they tend to be highly leveraged, right? So now we have a good sense of what kind of companies we're talking about in general, right? And they tend to be cheap companies, small companies, a little bit have low growth prospects, they've been underperforming, right? And they rank poor in quality. We can confirm that by doing a returns-based factor exposure analysis, and we have 10 years of data, so it's quite good. And if you look at the exposure to kind of popular equity factors like value, momentum, low overall quality, and size, we do see some differentiation, but also some similarities. So we do see that in terms of from a value factor perspective, that the high dividend yield funds have a higher beta than different growth funds. And that kind of makes sense because you can look at dividend yield as being a simplistic version of identifying cheap stocks. And often the stocks that are cheap have high dividend yields because they're kind of like companies in trouble or companies in troubled industries. We can see also from a quality perspective, right, there's some differentiation that the high dividend yield funds tend to be a little bit worse from a quality perspective, which is defined as a combination of profitability and leverage, versus the dividend growth funds look like slightly better. Having said that, in terms of other factors like momentum, low vol, and size, there's a lot of overlap here. The other point that's quite interesting, right, is that if you look at the factor betas to the overall stock market, as represented by the S&P 500, you can see that high dividend yield funds tend to have a lower beta than dividend growth funds, right? But the beta to the market is well, closer to 1. So that kind of confirms what we've seen from the holdings-based factor exposure analysis in terms of that the portfolios are broadly comparable, right? There are some differences, right? But now we have a better feel for the nature of the stocks. We can complement that by looking at the exposure to sectors. And here we do see some nuances. For example, we can see that the product from Vanguard, the high dividend yield fund, does have an overweight in financials. We do see that the product from iShares, the high dividend ETF, has overweights in consumer staples and energy. In contrast, we can see the dividend growth funds, right, in terms of VIG and DRGO. They do also have overweights in financials compared to the market. Now, the one similarity that all four ETFs have is that they are underweight technology compared to the S&P 500. And that kind of makes sense because tech companies don't tend to either distribute dividends at all or they prefer buybacks, right? And so that underweight to technology companies is as expected. Now, moving on to performance. So the good news is that we do have returns going back to 2014, right? So that we have, well, more than 10 years. And we do see that all four funds have underperformed the S&P 500. But we also see that there is some differentiation, right? We do see that two dividend growth funds have performed slightly better versus the high dividend yield funds have performed significantly worse. Now, we can look at this from a volatility and return and Sharpe perspective as well. It does seem that the S&P 500 is more volatile, but I mean, this is the difference in analyzed volatility between 16 and 17%, right? So the stocks in the S&P 500 are slightly more volatile, right? But you also have achieved a high return. And this kind of like brings us to the point that from a Sharpe perspective, especially the high dividend yield funds have generated much lower Sharpe ratios. So the product from Vanguard, VYM or HDV, Sharpe ratios are around 0.5 compared to the dividend growth funds where the Sharpe ratio is more comparable to the S&P 500. Now, that kind of concludes our short analysis in terms of comparing high dividend yield versus dividend growth funds. As mentioned, the dividend yield, as per the definition, is naturally higher for dividend yield funds. But the portfolios do have a lot of overlap. And we publish a lot about high dividend yield funds and income strategy in general. And so this analysis kind of confirms in terms of what we previously published about that usually when you reach for yield or buy high yield dividend funds, you tend to sacrifice return of capital for return on capital. And that's not attractive. Frankly speaking, a much smarter way to get yield is buy the S&P 500 and sell just parts of the allocation off periodically, which means you can create dividends synthetically, which doesn't sacrifice the total return, right? You're not going to have a much lower Sharpe ratio. Total return will be similar, and it's also more tax efficient, right? Because capital gains get taxed differently than income. Now, with regards to dividend growth funds, based on this analysis, there is no strong argument for buying those. It's also worth mentioning, right, that although perhaps historically consistent dividend growth was a quality characteristic, this in the US has become highly doubtful simply because so many healthy, highly profitable and lowly leveraged companies have decided to buy back shares rather than distribute yields. So stated differently, dividend growth funds don't make a lot of sense nowadays. Hope that helps. Have a nice day.